Good afternoon, everyone. Thank you for joining us. My name is Josh Brockwell. We're going to go ahead and kick things off. Just a quick bit of housekeeping. First of all, the webinar is being recorded, as you hopefully just heard. Secondly, we'll be taking questions at the end of the presentation today, but if you feel the need to ask something in the moment, feel free to use that chat box using GoToWebinar's control panel there, and if necessary, we'll take it as part of the regular flow in course of conversation. Most likely we'll hold it for the end, but if moment and mood strike you, feel free to go ahead and punch that in using the chat feature. With that, I'll go ahead again, welcome everyone, and thank you for attending Azzad Asset Management's 2019 Investment Outlook. Today we'll be hearing from Christian Greiner, Azzad Ethical Fund Portfolio Manager with Ziegler Capital Management, and he'll be talking about what investors could expect in the new year. So the next slide is a quick overview of the presenters. Your presenters today will be Christian Greiner, Vice President at Ziegler Capital Management and Azzad Ethical Fund Portfolio Manager. Christian's going to be joining us momentarily to offer up his perspective on matters. As I mentioned, I'm Josh Brockwell. I am the Investment Communications Director here at Azzad. As for today's agenda, just to give you a quick rundown, we're going to start with a look at things that are going in the right direction in the market today, things like stock market valuations and economic growth. We're calling those comforts. And then we'll explore some of the things to be wary of in 2019, things like interest rate policy, profit growth, and the ongoing trade war with China. We're calling those concerns. And with that, let's go ahead and get started. Christian, are you joining us?
I believe I've joined you. Can you see me?
Yes, we can. I'm going to turn things over to you now. Thank you for joining us from Chicago, and welcome.
Yes. Well, thank you very much. Greetings from beautiful, balmy Chicago. So I think it's always good to start off these webinars that we do by taking a look at where we've been. And really, 2018 was quite an eventful year. U.S. equity markets seem to be performing quite nicely for the first 3 quarters, climbing that proverbial wall of worry. Before concerns about tariffs and trade war with China and about earnings, how they will be affected by that, those really caught up with the market in the 4th quarter. So overall, the S&P 500 returned minus 4.4% after accounting for dividends. The 4th quarter alone saw a drop of 13.5%, erasing the year's gains and then some. While this was the largest annual drop for the market since 2009, a couple familiar themes did pop up. One of those was that growth outperformed value by almost 7% on the year, though value really came roaring back with a vengeance in Q4 as investors sold off some of their past favorites, and a lot of those names were classic growth stocks. Large cap once again outperformed small, with mid caps understandably falling in between the two. Healthcare and technology once again outperformed the broader market, though utilities rebounded this year. The energy sector once again was a disappointment, following natural gas and oil prices lower, while other cyclicals like materials and industrials fared poorly as well, hit by concerns over China. And finally, markets outside the U.S., be they developed world markets or developing world markets, were not the place to be, losing around 14% in U.S. dollar denominated terms. So let's take a look at a little bit at 2019 from what we've seen so far. And there's a saying that the first 5 trading days will dictate market returns for the full year. Basically, if this market's up 2% on those first 5 days, that being the S&P 500, it'll be up around 10% or more on the year. Since World War II, this pattern has broken down only 3 times. Unfortunately, 2018's 2.8% return on the first 5 days was one of those occurrences. But what we've seen so far in 2019 has been a classic January rebound rally, with investors snapping up perceived bargains in last year's unloved sectors and last year's winners lagging. Indeed, healthcare and utilities have been trailing the rally so far this year, and energy has been leading the way. One other historical occurrence to remember. Historically, third years of presidential terms are the best ones in regards to stock market returns. The Dow Jones Industrial Average has posted about a 21% gain over the past 9 decades on average in these third presidential years, with gains being posted 95% of the time. So now that we've taken a look at what has happened in 2018 and a little bit of 2019, let's take a look at where we are now. By a broad number of market indicators, this market's cheap, and at least according to the long-term averages, be it a 15 or 20 or 25-year average. The first of these is the forward price to equity ratio, and that uses analyst expectations for earnings, for company earnings. The S&P 500 was trading at 14.5 times multiple at the end of the year, and that's markedly below the 16.1 we'd observed over the last 25 years on average. If one uses a cyclically adjusted PE, which uses the average inflation adjusted earnings over the past 10 years, the market's overvalued. By some other classic measures, such as dividend yield or price to book, this market is not expensive. If one takes a look at price to cash flow, it really falls on that historic average. A number of investors like this measure because sooner or later you want to see those accounting earnings being converted into cash flows. The final measure is the earnings yield of the S&P 500, subtracting the average yield of debt on a BAA rated company. And this really measures the attractiveness of the equity market versus the debt market. Once again, the stock market seems relatively inexpensive or attractive on that basis. So with this relatively attractive backdrop in mind, we also have to point out that a number of market participants still have some reservations about future returns. This chart is of the VIX, an index of expected volatility that can be extrapolated from option prices on the S&P 500. Without going into too many of the gory details about the calculation, really the higher the number, the more volatile traders are expecting the broad market to be. And so some call this a measure of fear in the market. With its recent reading of 21, it's above the long-term average of 19. While the latest spike was pronounced, it's really not close in terms of severity or length of, say, the US debt downgrade in 2011, the Greek debt crisis in 2010, and a far cry of those 70 or 80 levels it reached during the financial crisis, the US financial crisis of 2008. So with that in mind, the big discussion in the financial press is, are we in a bear market? Have we finally seen the end of one of the longest bull markets in US equity market history? And if one uses the classic term of a 20% drop from a closing high, then we have not hit a bear market yet in terms of the S&P 500. The close on December 24th was 19.77% below the closing high in September, and we've seen a pronounced rebound from there. While other parts of the US equity market did enter bear territory, this close call may help market sentiment, and so far it appears to have done so. Still, we'll see if this relative positive sentiment holds as we enter earnings season, though, as we go through Apple and some of the bank earnings.
So, Christian, if we do have another downturn and we enter a bear market, does that mean that the economy will automatically go into recession?
Not necessarily. We've had bear markets without recessions and recessions without bear markets. However, more often than not, the two do go hand in hand. Using our last 6 economic cycles as benchmarks, once the 2-year yield goes above the 10-year Treasury yield, the 2-year Treasury yield goes above the 10-year Treasury yield, that's an unusual condition known as a yield curve inversion. The stock market peaks about 10 months after that. From the stock market peak, it usually takes another 5 months for a recession to take hold. But just a reminder, these are broad guideposts. Remember, recessions are usually discovered after the fact. The last recession that we had, 2007, took about a year to be discovered by economic authorities and confirmed that we were indeed in a recession. So if we do have a sell-off during a time of economic expansion, which it appears by most guideposts to be the case right now, what often happens is that within the next 6 months, the market repairs most, or if not all, of the prior damage. And some of these years that I have in front of us are past occurrences of this. While many market observers could quibble if the economy is still growing strong or is in the midst of a slowdown in the growth rate, there really aren't any saying that we are in the midst or cusp of a recession right now. Right now, people are putting the odds of recession in 2020 at about 20 or 25%. So indeed, the sell-off has a lot of characteristics of the one in early 2016, if you remember clearly. Investors sold off on slowing growth concerns. They sat those proceeds in cash for a little while, and then they bid up the market as the year went along. So one reason why past market or economic cycles may not apply to this economic recovery is that it may be different than past ones. While it's the second longest uninterrupted recovery in the post-war era, and it could become the longest this year, I think sometime in June or July, if I remember correctly, the cumulative growth has been far below that of previous expansions. Many reasons have been bandied about for this. The fact that we were bouncing back from a financial crisis, the tightness of credit through a good part of the recovery cycle, or even the uneven distribution of growth of these returns are three popular theories. And depending on your perspective, you could say this means that there's some runway for further growth for this economy, or that there's a smaller margin of error in terms of monetary and fiscal policy for authorities. And the reason why this particular recovery has been so relatively disappointing in terms of aggregate GDP created is that the fact that GDP growth in the US, and that's gross domestic product, really never reached the escape velocity of over 3% that a number of market participants and economists look for in a robust recovery. In fact, since the recovery began in late 2009, the average for this recovery has only been about 2.2% of GDP growth. And while we can see that 2018 saw an acceleration of that growth, it seems to remain on trend from the 1.4% trough that we saw in 2016. So with that, of course, there'll be some debate that if the Tax Cuts and Jobs Act of 2017 served as an impetus of this economic growth in 2018, and if so, what was the net effect? And that's really hard to suss out. As a quick aside, GDP growth is expected by the Atlanta Fed, using the nowcast that you can get on their website, to be at around 2.7% for the first quarter of 2019, while the consensus of economists is around 2.6 to 2.7%, with a range of about 2% to 3.1%.
Okay, thanks. So that's kind of an overview of the comforts for the coming year. At this point, we're going to need to talk about some of those concerns in light of that picture you've just painted for us, Christian.
Well, sure. So one issue that may be grabbing an undue share of the headlines right now is the government shutdown. So when I was putting this together, this shutdown was the second longest in history. It's now, of course, the longest. And what a lot of economic research shops continue to stress is that in the long term, government shutdowns usually don't have a large effect on economic or market activity. There might be a spike of uncertainty, but over the long term, as the saying goes, the roads end up getting built, the checks end up getting sent out. So still, it's prudent to point out that 17.2% of GDP comes from government spending of some kind. And to put a more striking illustration on that, around 800,000 workers have or could miss paychecks in this coming cycle. The ripple effects of this are being felt as rent and mortgage payments are postponed, consumption is being cut back, and while some of these workers will get back pay, often government contractors, they do not. Another aspect of this is that tax refunds may be delayed. Remember, this is the first year that with the new tax code, and a lot of people are going to have some questions about how that affects them. Any delays in this spending could affect the earnings forecast for a number of consumer discretionary names. In a more big picture scenario, if government economic data releases are delayed, it actually could affect the Federal Reserve's interest rate decisions. And we've already seen some researchers take down their GDP growth forecasts, albeit slightly so far. So another issue that's been capturing the market's attention, especially over the last couple months, is the machinations inside and around the Federal Reserve. Jerome Powell took over as Fed chair in February 2018 and signaled a continuation of the policy regime set forth by previous chairs Bernanke and Yellen. So it's helpful to remember that financial markets often do confront Federal Reserve chiefs and chairs with crises of various severity within their first year of their tenure. For Powell, the task is especially tough. The Federal Reserve's trying to shrink their balance sheet from 3 rounds of quantitative easing in a steady, well-communicated manner. What that does to debt markets and risk asset prices in general, that's really still a matter of debate, and one that we're living out in real time here. The Fed is also trying to go by the usual playbook of tightening monetary policy to stem off inflation while not hurting economic growth in times of expansion. So the president has taken to task some of Powell's decisions to continue to tighten interest rates, and the markets have followed suit. Volatility around some of the Fed officials' appearances and missives. For a president that measured his job performance by strong stock market returns, higher rates could be seen as a threat to that. So this led to rumors if the Fed chair would be fired, a move of questionable legality and strategy. And this played out a lot in December. This move could have sent markets in further turmoil, as you would imagine. After all, the Fed does have a dual mandate of stable prices and maximizing employment. And by those measures, they seem to be doing a pretty good job. It's also good to remember that tension between the Fed and the occupant of the White House is really, it's a normal thing. Reagan ordered Volcker to not raise interest rates during the 1984 election. Clinton and Greenspan famously did not see eye to eye. Bernanke and Obama were at loggerheads over inflation during the recovery. So this is a relatively normal state over the last 40 years or so. So what we take a look here in terms of interest rates is that the Fed funds rate is at 2.5%, and this really puts some of these discussion of rates into context. This chart of the Fed funds rate, which directly or indirectly drives a number of interest rates in the economy. At its current upper bound of 2.5%, it's really still below the 3.2% historical average. Now, a good number of monetary scholars will tell you that it's the pace and the expectations and how those rates are communicated that matter. But what has followed has sort of been a steady pattern so far, as we can see sort of with the ramp up there compared to prior ramp ups. And the Fed's expanded commitment to transparency, think of all those scintillating press conferences that Yellen and Powell hold, are helping take some of the past mystery out of the Fed decisions. So with that in mind, it's always interesting to see what the Fed and their small army of economists are projecting in the near future. And that is for a slowdown in GDP growth, but not necessarily a negative number that would indicate a recession. A bottoming out of the unemployment rate as it ticks back up, and inflation that is at or near their stated 2% target range. All this could indicate that we're relatively late in the economic cycle. So one of the biggest concerns for the US stock market going into 2019 is a slowing of the pace of profit growth for the S&P 500. One could believe that this was inevitable. The Tax Cuts and Jobs Act of 2017 cut most corporations' taxes and boosted their profit margins. There is a belief that some of these would go towards boosting employment and wages, stimulating business spending through a tax break on capital expenditures, and really stimulating growth across the economy. The jury is still out on those effects. What we can easily measure is the large amounts of announced share buybacks that occurred in 2018, almost double of what we saw in 2016 and 2017. While this can boost earnings per share growth for a stock, there's less shares to split those profits. One has to wonder if this is really the best use of capital when multiples were above average, as they were at the start of the year, start of 2018. We also did not see that huge spike in CapEx activity that some had expected. In fact, we saw it peter out a little bit during the back part of the year. Some were also looking for a marked increase in merger activity, which also did not occur, or at least it has not occurred yet so far. So while the 9% earnings growth currently projected for 2019 for the S&P 500 is around average, there are concerns some companies may have difficulty lapping those gains, so, those 2018 growth numbers on a year-over-year basis. And one good way of taking a look at this is this chart here of earnings growth through the years. And this chart takes a look at earnings expectations for each calendar year for the S&P 500. These usually follow a pattern. Analysts put out rosy profit projections for the companies they cover, and as the year goes along, they get taken down. the last couple of years, as analysts anticipated the effects of the Tax Cut Job Act of 2017, these numbers actually got a boost as the year went along. As you can see, most of these are downward sloping. Last couple of years have actually been upward sloping. So it will be interesting to see for 2019 and 2020 there, which have just started, how these estimates fare during the first few months of this year. We've already received some unsettling earnings projections from a couple large companies, think Apple, and one has to wonder what any negative economic news could do to this. So when one takes a look at earnings growth projections for 2019, most sectors are looking at earnings growth below their 20-year average. Right now, sectors projected to grow earnings faster than the market include industrials and consumer discretionary. Materials, healthcare, and tech are supposed to grow earnings at a below average clip. That doesn't mean that there aren't opportunities in each sector or that these projections could change as the year goes along. So this brings us to probably what is the paramount concern for the markets right now, the proposed tariffs and trade wars going on between the US and China. And the number that captures the public's imagination right now is $200 billion of Chinese goods that the US could slap a 25% tariff on. And China's already identified a similar amount in US sourced goods that they could retaliate on. The reduction in trade and the increase of prices on the consumer would really effectively serve as a tax on the consumer, and hurting growth on both sides of the Pacific. And we've seen this before. The economic literature on trade wars show that both sides usually do come out harmed. There's been some optimism that cooler heads will prevail when a 90-day truce was declared in November in Buenos Aires. But since then, that optimism has dissipated a little, as little headway has really been made. So while much has been made from certain politicians, how much China needs the U.S., it needs to be highlighted that the U.S. economy also needs to sell into China. While Chinese economic indicators have been showing a slowing economy over the past 6 months or so, putting pressure on President Xi to stimulate growth, a quick look at American trade balances show a number of industries that depend on selling into China to drive their growth, everything from industrial laser makers to luxury goods. So the risks for the U.S. economy have been well covered on the news, and we've seen stories about soybeans set for export rotting in silos in the American Midwest, or how about U.S. manufacturers unable to profitably source certain parts for their goods. And of course, recently Apple issued a once every decade type of profit warning, blaming in part slowing Chinese demand. For U.S. companies, taking a look at who sells into China is no surprise. Tech companies sell their goods and expertise into China. Materials and staples companies, right below that tech bar there, rely on growing Chinese consumer demand for everything from building materials to infant formula. Less exposed to the U.S., less exposed really are the U.S. real estate, the energy, and healthcare businesses. Still, an implementation of a full tariff regime, that 25%, could cause an economic slowdown on both sides of the dispute. This can't be stressed hard enough. This could lead to a reduction in earnings estimate cuts for the S&P 500. And further out, if one wants to go into economic theory a little bit more, one could actually see a stagflation scenario. Stagflation, of course, being famous from the 1970s. And in this, the U.S. consumer has to pay higher prices for goods that it used to import, while facing stagnant economic growth because the export markets for the U.S. have been curtailed. The Fed could hike rates to slow that pace of inflation down caused by those higher import prices, but that could actually damage the economy even further, and the cycle would just continue. So there is a disproven urban legend that there's a Chinese ideogram for crisis, and it's a combination of opportunity and danger. And while this may not be true, there's some truth that moments like these do offer opportunity to investors. It could be argued that much of the damage caused by the trade war has already been priced into a number of stocks and industries. Indeed, since June, when this rhetoric was really ramped up by both sides, stocks with larger China exposures have markedly underperformed their more domestic-focused peers. A number of these names have had large moves higher on really any positive headline on the trade negotiation front. So indeed, there have been some that have noted that the defensive trade that performed so well in the second half, you think about those utilities and consumer staples and healthcare, that all this may have been exacerbated by these fears over China. After all, some of these best performing industries, like pharma and biotech and like US utilities, have the smallest demonstrated sensitivity to China. In the end, one could expect cooler heads to prevail. As noted before, both sides do need each other and their markets to sell their goods and services to drive economic growth. While this may cause volatility for months to come, one could hope that further damage will be limited. So with that in mind, here's a couple other measures to watch in 2019, other than earnings growth, PE multiples, interest rates, and political risk headlines that we all just discussed. And the first of these is the US Treasury yield curve. We talked a little bit about those inversions. And the yield curve is the going rate on what the government pays to borrow by selling treasuries at different time frames. Most of the time, the longer the term of the bond, the higher the rate. You're compensating somebody for their time and their risk. There are times of market stress and uncertainty when this relationship breaks down, and we're seeing that a little bit right here. When short-term rates are higher than long-term, you see the curve and the buckle there on there. These are often seen as a harbinger of recession. One indicator is the spread between the 10-year and the 2-year Treasury. We've talked about this a little bit before. If that turns negative, it's seen as a big warning signal. But the joke is that that measure has called 11 out of the last 8 recessions. There's times when it says a recession is coming that it doesn't. So historically, if you take a look at the data, the 10-year minus the 3-month Treasury spread is much more reliable. It hasn't inverted yet, though at about 28 basis points, it's about as low as we've seen since the financial crisis. This next one is the Consumer Confidence Survey, and that's run by a division of Nielsen. It measures if consumers feel that business conditions have or will improve, if jobs will be easy or hard to come by. And this seems to indicate that the recent market turmoil may be starting to concern Main Street as they take a look at their investment portfolios or take a look at the headlines. So with consumption by U.S. citizens being at least 68% of GDP last year, consumer sentiment may need to be monitored closely. So while a lot has been made about the historically low unemployment rate, and it's really a pleasant chart to look at, I also like to take a look at the U.S. job openings total released monthly by the Bureau of Labor Statistics. And a rising number, as we see here with this graph, shows an economy that is creating and having a hard time filling jobs. This should, in theory, help keep unemployment low as employers compete for talent. They should boost wages, something this economic recovery has been lacking. If we start to see a protracted effect from a trade war, and this particular chart start taking a downward slope, we might see it in this indicator earlier than some other economic indicators that people like to watch. And we spent more time than usual talking about the Fed, so we will also be watching one of the measures that they like to watch. If we see wages rise, by logic, prices should soon follow. One could imagine that the pressure on the Fed to slow the rate of wage increases, any sign of inflation in the U.S. market would be seen by them as a sign that they need to raise rates to slow down an overheating economy. So this CPI, Consumer Price Index, is showing, that right now that inflation is relatively benign. So right now there's only a 25% chance that the Fed hikes rates once this year, at least according to market expectations. If we see a spike in this consumer price inflation rate, those odds could rise. And of course, what we also have to do is take a look outside of the US. While we focus a lot on the US with this presentation, it's good to remember that at least a third of S&P 500 profits come from overseas, and that percent's been steadily growing. So we also keep an eye on some of the foreign markets and political headlines on our day-to-day research. Of course, first and foremost, the Brexit drama has flared up again, with the March exit timeline still being adhered to by Prime Minister May's government. I believe there's another vote set for today or tomorrow. There have actually been more rumblings of a second referendum vote being put to the public to just make sure that they want to go through this Brexit. Right across the channel, the economic populism in France has really taken root with the Yellow Vest protests, and it threatens to derail some of the market-friendly reforms that French President Macron has tried to implement. Within Italy, economic populism also threatens to slow the pace of reform that the government and banking system really need. And within Germany, more readings are really starting to come forth that the German economy, which has really long been the growth engine for the Eurozone economy, is weakening. Within Latin America, the Brazilian markets have received a shot in the arm with the election of a new president. He's seen as more market-friendly and putting in officials that are like him. The question is, have these changes already been priced in? And within Mexico, the newly elected president, Obrador, just enacted legislation to cut taxes along the U.S. border as a way to stimulate growth by stimulating wage increases. The current situation in China probably warrants its own slide, and really probably more time than I will dedicate to it here. This past year has really seen China pulling on various monetary and fiscal levers to stimulate its economic growth. Remember, they eventually want to go from an export-based economy to a consumption-based economy, but that's really a tricky transition to pull off. Because of the large amount of debt on Chinese banks' balance sheets, Chinese authorities have made moves to maintain the stability of their financial systems and markets as they stimulate this growth. These measures they have taken really haven't seemed to take hold so far, but projections from outside economic groups tend to point to a bottoming out in economic growth about the 6.2% or 6.5% range in this quarter before it starts rebounding in, say, the second quarter of 2019 and moving into 2020. How this will affect U.S. markets is a concern. Chinese demand and exports affect many sectors, with tech, materials, and consumer discretionary coming to mind immediately. While the direct effect on S&P 500 earnings are relatively small, the effect on the global economy really should not be understated. So wrapping this all up with what we're going to watch for in 2019, U.S. equity valuations have come down considerably from the past year, and especially below their long-term averages. Technology and industrials are particularly cheap on a PE basis. Defensives like staples and utilities are relatively expensive. Earnings growth should still be positive, but it's going to be slowing. We're going to probably be looking at about 9 or 10% of EPS growth over the next couple of years. And while the economic fundamentals are relatively strong, we have low unemployment, strong orders, that remains supportive of an economic expansion. With that in mind, the risk of a recession is higher than it was a year ago, but by no means a certainty. We talked that some see it about a 20 or 25% odds of a recession in 2020. But one thing to watch for is slowing global growth. Last year when we did this webinar, we were talking about synchronized global growth. U.S. is sort of breaking away from the rest of the world in those terms. When we take a look at the Fed, we have to take a look at the pace and timing of interest rate hikes and the uncertainty that surrounds that, especially when compared to a year ago. Right now, we only have one hike currently priced in, and that is basically because inflation is still benign. If we see inflation pick up, it'll be interesting to see the language that we get out of the Fed in regards to that. And one thing to also consider is that the market may be looking at more turbulence. And when we see that, it's good to stress that in times of market stress, importance of cash flows and solid valuation to make sure that you have companies on solid footing that aren't particularly overpriced. You look for management teams that have successfully weathered downturns in the past and actually used them as opportunities to grow their business. And so that is what we are aiming to do here with this particular fund.
All right, Christian, thank you. Give you a chance here to catch your breath, maybe grab a sip of water as we turn to the question and answer portion of today's presentation. just a reminder that if folks do have a question for Christian, you can open that dialog box on the GoToWebinar control panel and send it our way. Just the general question I'm seeing on occasion, Christian, around the office anyway, and I'll use the presenter's prerogative to kick things off, is one related to general uncertainty in the markets, specifically as it relates to the government shutdown. And I know we've seen some news come out of late implying that the impact may be of a much greater magnitude than was originally projected. Do you have any thoughts on that since the original drafting in this presentation?
Yes, so as the days go by and we reach this particular point where it is now the longest in history that we've seen, you have to be sort of mindful of the fact that we are in uncharted territory, and therefore maybe the effects on the economy are going to be in uncharted territory. What this does to the consumer sentiment that we looked at in terms of Nielsen, what it does in terms of consumption from those that are either employed by the government or depend on checks or are contractors, and what this does to the long-term confidence with that. So this could be resolved tomorrow, but with Congress and the White House at loggerheads, as we've seen, there's nothing to say that we won't do this again. We do have the debt ceiling debate coming up once again. And in the past, that has been quite contentious. So this is something that could be seen as something that adds volatility to the market. But so far, we haven't seen anybody really take down their GDP estimates by a large amount. But that's something we're watching from some of these economic groups.
Well, it's interesting you mentioned GDP as well, because there's talk that the shutdown can affect the government number crunchers and folks that actually compile that data, which has an impact on a lot of things, including the Federal Reserve's interest rate policy.
Yeah, it's these waterfall effects, these second or third order effects that, frankly, we're going to find out how the severity of those are over the coming months. Hopefully this gets resolved in relatively short order, and I believe there is legislation out there that federal employees will be getting back pay. But we want to see everybody get back to work. We want to see those numbers come out. We want to see everybody going back and having some stability in terms of their planning, and that's something that we need to remember.
Sure, can't happen soon enough. Quick question here. I'm seeing on the trade wars with China, do you see a resolution to that anytime soon?
There is, my belief is that cooler heads will prevail. Both sides need each other, and both sides really can't risk an economic slowdown or exacerbate one by having this happen. So we're starting to see progressively a little bit better headlines come out of this, but that March 1st deadline in terms of that cooling down period, it's going to come quicker than we imagine. And if we're not seeing a lot of positive headlines in February, it could be something that could cause more volatility within the marketplace. But I do believe that sooner or later, both sides are going to give a little bit in terms of either protecting intellectual property. That's a big concern. The other one is, of course, opening markets, and we should see some relative progress on those fronts. Let's put it that way. But neither side's not going to do everything what they want.
That's the nature of compromise, right?
Exactly.
So another question here I'm saying, and this is maybe more specific to the Azzad Ethical Fund or socially responsible portfolios in general. As much of the audience probably knows, the Azzad Ethical Fund is halal, screened according to our investment criteria, which avoids industries, sectors in certain lines of business, as well as certain financial ratios. And the question is surrounding any insights you might have about the outlook specifically for those types of socially screened portfolios or halal screened portfolios.
Well, there's something to be said, and I'll use the Azzad Ethical Fund as an example of that. By nature, usually our fund is overweight technology and overweight healthcare, And within technology, we saw quite a sell-off during the fourth quarter, and as you would imagine there. That was a lot of those names were the ones leading the way upwards. And some of those names were oversold and still have quality growth prospects. And for those, when they reach that oversold condition, you'll see more people come in and sort of snap them up and buy them up and say, okay, finally I'm getting this really good growth rate on a relatively low valuation. And that's what we're seeing some of that now. So when we rebalanced the portfolio, we took that into account, that these particular names that pass our screens that were sold off could be ones that could really outperform it as the year goes on, and we sort of ramped up the exposure to say technology or exposure to growth in that way.
Gotcha. Yeah. Okay. Seeing a couple more questions come through, giving folks an opportunity to ask those, again, using the GoToWebinar control panel, the chat box there. There's a question here, Christian. I don't know the extent to which you can answer it. It involves your take on IPOs in 2019 and their impact. I guess maybe point out the easy answer to that would be, with the SEC affected by the shutdown, I think a lot of those big IPOs that they were talking about, the Ubers and the Lyfts and the Airbnbs out there, could be put on hold. I know you can't talk about specific names or it's frowned upon, but in general, your take on maybe just sort of the business environment and the climate out there for 2019?
Well, we do have several big names that people are looking forward to. And traditionally what you see in those IPOs is people taking either some of their money out of their previous hot names within their portfolios and saying, okay, this is the money that we're going to use to invest in this or that when it does come public. Now, we've seen sort of a relative lull in IPOs, and it's going to be a little bit more here with the government shutdown. And it sort of goes into the bigger question of, is it as advantageous for a company to go IPO as it once was, that you have more companies that are willing to stay private and not deal with the onerous regulations of reporting, doing quarterly earnings calls, and all of that. They've seen, some companies that have gone IPO that have had a really tough time with that, with the increased visibility. But I think it would be sort of a shot in the arm for some of these larger names, specifically within the tech sector, to come out and sort of reset our beliefs on growth here, of what it could look like, and the overall growth rate that maybe we could get in these indices as these guys are included. So while we don't typically invest in IPOs right off the bat as they come out of market, it is something that we do watch. And we watch its effects not only on individual companies and competitors, but also on sectors as well. Great.
And for those who have more questions on IPOs in general and how they relate to halal investing, we invite you to take a look at that Investing in IPOs white paper on our website. We've got some good information there. Christian, I have another question for you here that looks like it maybe has reached out and it's grabbed us from the past. This looks like a question that's more appropriate for 2018, but it still has application, I'm sure now, and it is, are blockchain technology and cryptocurrencies going to have any positive impact in 2019? I know that was all the buzz last year.
Well, in terms of positive impact for, blockchain, and I'll sort of go with that. That's still an evolving technology that a lot of companies are using and finding new uses for. Is it something that's going to be dominating headlines as much as it did, say, 2017, 2018? Probably not. And what we saw with cryptocurrencies, was sort of a traditional bubble cycle. But we're still finding all kinds of different applications for blockchains, especially with decentralized ledgers that can be used across several industries.
Sure, for things like banking and financial transfers and things like that, low cost, no cost transactions.
It's going to change the way that people do those things, if it hasn't already.
Yeah. All right. Well, a hopeful and optimistic note to end this webinar on. I think we might end up wrapping just a little bit early if there are no other questions. And yeah, it looks like we will go ahead and bring it to a close. We will, of course, remind folks that if you have additional questions, you can reach out to us anytime here at the office, 888-86-AZZAD. You can also email us info@azzad.net. I'm going to go ahead and bring up that last slide for the disclosures right now, which our compliance department always likes us to show. We want to thank everyone for your time, and thank you very much, Christian, for being with us today.
Always my pleasure, Josh.
Thanks, and just a reminder to folks to visit our website, azzadfunds.com, where you can download and read your free copy of the prospectus for the Azzad Ethical Fund. The prospectus contains more information about the fund's risks, expenses, and investment strategy. While you're there at the website, you can also sign up to receive our monthly e-newsletter to get more information about our products and services. Finally, be sure to follow us on Twitter @Azzad Funds and like our Facebook page, facebook.com/Azzad Funds. And let me also note that a recorded version of this presentation will be posted to our YouTube channel, youtube.com/Azzad Funds, very soon. So be sure to take a look. And thank you again for your time, everyone, and have a great afternoon.